Mhm.
So everyone solves a little bit different part of the puzzle. But to get at this deal, here and a little bit about Offered, I don't know if you know anything about us, but essentially what we are is we are a data-driven acquisitions firm, and alongside of us we have an investment arm.
Mhm.
So Michael in Cross Mountain Capital is one of our clients on the acquisition side. And then on the capital management side, we're coming in on this deal and co-sponsoring it because we feel strongly, and we identified this asset through we've developed a value add model, which pre-identified Ingall's Grove and this little submarket as an excellent value add target. And so we take those targets and then we have in-house people, they reach out to owners directly. And that's how we originate deals off market with a, kind of a sniper based approach. So this deal was sourced after, 2.5 months of rigorous campaign, which is actually quite early in our campaigns. But sure enough, we get in there. I've been at the asset myself. You look across the street at terraces. What's the comp right across the street? The terrace.
So, to-
Terra Village.
Terra Village,
Yep.
exactly. And you go, man, they're getting the rents that we're pro forming after we spend, $1 million in capex. That's a pretty easy, mental leap to be made. Not to mention the fact that just across Sheridan there, you can just see things pushing out.
yeah.
And 70s product, interiors really haven't been touched. These guys rode the gravy train on, last couple of years, organic rental growth, fine. So they're going to exit, they take their profit, but we come in and now we execute on the value add strategy. So, that's the story here. And we're doing exactly that. We're getting in there, we're spending, close to about 12,000 a door. These are good renovations. We're going to take this from really a C product to what I believe to be more of like a B minus product. And we're going to introduce some, outdoor amenities, rebrand it. And but it's got excellent bones. It's in an excellent little submarket there. You should drive by it. I don't know if you have already. Off 26th Street, good road frontage. And the debt markets have opened back up. We got an excellent bridge loan here with 3 years of IO. They're funding 100% of the capex. And and we get to buy a rate lock there with 2 1-year extensions. So, the business plan is exactly that. It's, through COVID, these guys have stayed and then, over 90% occupancy, collection loss has hovered in the, 6-ish%, if you will, which is pretty good, not bad.
Yeah, it's in line with pretty much the national average. You look at NMHC or any of those big publications, that they're
Yeah.
right around there.
Yeah. And so we're going to come in, we're co-sponsoring the deal we don't have Andrew here because it was kind of short notice, but we have an in-house asset manager here at Offered. Offered it's not a huge company, but we got 15 people working for us. We're not, kind of like 3 guys in a spreadsheet, if you will. So we're bringing our asset management expertise, of course, our data, expertise. We are bringing our investors into the deal as a co-sponsor alongside Mike, and hope to do many more, after we get this one closed. So I'm here to answer any questions, and I think we
Yeah,
have someone else join.
Well, really quickly, nice to meet you guys. I actually joined locally myself. I'm Mike Gilman. Just a quick note about myself, my background. I started my career as an attorney in the investment banking world. I did a few tours around the street, and then ended up at a sort of a high-flying startup, Easy Knock. It's a real estate prop tech company where I had a unique position, running the legal department as well as overseeing their in-house single-family portfolio, which by the time I recently left to focus on Cross Mountain was upwards of $250 million. And then independent of this, throughout, I'd say the last 6 years, I've been building up, using my own balance sheet, a high cash flowing portfolio here regionally in the Northeast. I'm based in New York, out in Westchester, but I primarily focused on some secondary markets with higher cap rates where, you know, they weren't sort of bad
Cash
neighborhoods
cows.
or zones, so to speak. Yeah, cash cows. So my investing took me to Vermont and New Hampshire, where I assembled about 60 units, which we self-manage through another entity. I self-manage through our team. And so Denver has been a market I've personally been watching for many years, I'd say for the last 5 years. And you know, every time I looked at a deal or tried to enter the brokerage process, it was super tight, super competitive. Spreads between your financing and the cap rate were razor thin to going into COVID. I don't even know how some people were cash flowing, you know, at closing. You know, some of these deals just look negative. So I sat on the sidelines, and then when COVID hit, and I saw the easing started and you had rates drop 200, 250 basis points, I thought it might be a good time to enter or to try to enter the market. Even if cap rates stayed the same, you have these widening spreads, which is historically a great time to invest. So with that in mind, I knew I wanted an off-market deal. You know, going into a new market, I'd wanted the advantage of just being able to source something on an off-market basis, and that led me to Offered. You know, I was comparing all the platforms, and I quite frankly, I didn't see anything like it out there. Just sort of best-in-class analytics coupled with best-in-class, you know, an acquisitions team. The guy that runs the team, Ken Hoff, he was a former head of the Marcus Millichap office in New York. He's personally done upwards of $3 billion of acquisitions and dispositions. I know he's been worked independently for private equity funds or family offices, and certainly Travis knows more about that than I do. But so sort of first-in-class team. So anyway, we went to work on the Denver market. We started with a list of about 150 assets, and we actually had a surprising hit rate. Typically, it's in any given year, right? 1 to 3% of properties will transact. But we were talking about 6 sort of bona fide sellers, at least people that were giving us the T12s and looking to make a deal. And this deal here sort of hit all the check boxes for me, which was heavy value add, up and coming area, and especially I was looking for some COVID protections in the submarket. Namely, I didn't want population density, wanted a more rural area, and that's what we exactly what we got here. So with that said, happy to learn about yourselves and field any questions.
Yeah, great. Well, Travis and Michael, thanks so much for the introduction. I'll give you kind of a quick and dirty on me as well, and then I do have a couple questions on the deal. But I'm the director of research for Yardi Matrix. So Travis, I know you're familiar with Matrix. Basically, to boil it down into a one-sentence answer, my job is to marry all the real estate data that we have within Yardi with publicly available information like job growth and domestic migration, wage growth, et cetera, and basically tell stories about markets, tell stories about submarkets. So pre-COVID, I was doing a lot of speaking, a lot of traveling, visiting clients, going to conferences, kind of sharing our data. Now it's more kind of on the written side and presented through Zoom channels and things like this. But that's kind of the core of the 9 to 5. And I guess part of that too is I also manage all of our research analysts for storage, office, industrial, and multifamily as well. But for about 8 years now, I've also had, I guess, a side business, side hustle, whatever you want to call it, of owning and managing single family homes. Mm-hmm. And so that was before I even started with Yardi. Kind of got brought onto Yardi about 5 years ago. And through the process, you know, not only am I working for Yardi, but also trying to build connections and trying to LP mostly on deals at this point. Who knows down the road, maybe co-sponsorship, GP, whatever. But I've partnered with a couple of groups as an LP in Texas, working through some deals in Colorado Springs, Denver. And so that is really what kind of brought me to Michael Lynn and to you guys. And so with that said, I love the location of the deal. This submarket is a home run when you're talking about Denver specifically. For the past, I'd say 3 to 5 years, the Sloan's Lake area has been the last of the inner ring suburbs that have been gentrifying. If you guys know Denver, you know Rhino, Highlands, those were 5 to 10 years ago. And the Sloan's Lake area is that exact movement in the last 3 to 5 years. I have a number of friends. I'm 30 years old. I have a number of friends from the say 25 to 40 range that all they're doing is looking in the Sloan's Lake neighborhood.
Mm.
And so when you think about that migration from the Highlands, from downtown, the people that aren't yet ready to move to Aurora, Arvada, Centennial, but want to be a little bit further out, a little bit bigger spot, whether it's an apartment or a home, this is exactly where it is. It's north of Colfax. I know you guys are on the other side of Sheridan, but I'm very bullish on that flow continuing to overflow into Edgewater over Sheridan. And I mean, I think you guys have hit a gold mine for a location.
That's good to know.
Yeah.
I'm glad I'm taping this.
So I guess about the deal itself, couple of questions. First, let's start with the property management company. I understand that Rio is currently managing them, and they would continue management after you guys close. Do you have previous relationships with Rio, or do you have confidence that they can handle a value add?
Yeah, so no, we don't have any previous relationships, and we evaluated a number of different groups, 3 different property management groups that, you know, really are good at this size of deal. This is a 54 unit deal. So it doesn't have on-site property management. It doesn't have on-site maintenance. And what I've learned is that's kind of the model for this, you know, size of community. And at first I was skeptical of Rio, but we, you know, traveled there, visited their office, saw their operation. And Chris Malley, their COO, you know, they're a pretty impressive operation. They centralize all their leasing. They probably got 50, 60 people, you know, leasing, you know, they have a maintenance crew. They have a, you know, nice office. They snowplow everything. They have their own HVAC. He's done some of their own deals. They used to own and operate. And so, you know, we toured some of his value add deals down on South Broadway, which is another market that we also like. You know, executed exactly the plan that we're looking to do. And so we were impressed. They got in-house resources and know what they're doing from a, you know, from a value add perspective. And then from the other stuff, you know, that gets subbed out on the exterior items. You know, we're going to replace the windows. We're going to add exterior amenities and sort of landscaping. But from an interior perspective, when we're talking about just doing kind of like 2 units organically a month, you're not going to get the attention of, like, you know, a big contractor to come. They want to do it all at once. And so I think there's a good natural fit with them. And I validated that, yeah, they can get the product done.
Okay. Do you guys have anyone local or do you plan on coming out to kind of administer the value add, or what's your strategy there?
Yeah. So let me feel that one. So I personally plan to visit there periodically. I'd say at least try to shoot for bi-monthly or once every quarter at minimum. But above and beyond that, I have actually a close personal friend who's an architect, and we've budgeted a little bit for just some on-site supervision. Just we have a checklist because, you know, one of the things we flagged was we have a great asset manager, Andrew Pope. He's done $500 million in the market, but he's located in Florida, and certainly he'll be flying down. But we didn't overlook the fact that at least I personally, at least self-managing my portfolio, it's really important for me to really have that on the ground presence there, kind of looking over.
In the beginning, there'll be a lot. We'll be spending a lot of time there, and it's a quick flight. But once we get rolling on the interior stuff, especially, you know, we have the budget in place, we have the materials, we have the program. You know, we are currently speccing out everything, and may utilize this interior design firm to we have a template. It should be fairly streamlined, you know, down the road. And you know, in terms of you know, asset management and so on and so forth, boots in the ground matter a ton. And again, it's a quick flight over. So.
Right. Okay. Sounds good. I took a look at the underwriting. Michael Lynn had sent it over. I think personally, the 5% annual growth after 2023 on the rent side might be a little aggressive. Um, how do you guys feel specifically about that number? Kind of where did you come up with that? I understand you guys have your algorithms, but um, I guess also kind of a second part of that is your strategy to kind of shoot aggressive and try to nail it right on, or would you prefer to underwrite a little bit more conservative and hope for an upside?
Yeah, so with Michael, we did stress test the model and modeled out various different scenarios, which included reducing that rental growth to, I think, like 0 for the first 2 years and brought it down to 3%. And it still comes out to be about a 16 or 17 IRR, net to investors. But so by no means are we banking on organic, rental growth. We are, very confident in our value add strategy and forcing appreciation, through that. I would say this: pre-COVID and historically, the Edgewater market was growing at about 6 to 7%.
Yep.
So considering that there's been no rental growth in this market and seeing that there ain't any new construction coming online, I think that there's a strong argument to be had that it could be more than that. So, but by no means are we, as the model and as the outcome, dependent upon knocking it out of the park on organic rental growth.
Right. Okay. That's really good to hear. I agree with you. I mean, having watched the Denver market for the past 10 or 12 years, we have seen pretty outsized growth on average. I wonder what's going to continue to drive that. I mean, pre-COVID, we had a number of issues around affordability in Denver. Now, obviously, with COVID, we saw people leaving San Francisco and New York in droves, and they had no problem paying Denver rents. In fact, they were thrilled to pay Denver rents.
Mm-hmm.
So there's that kind of continuous trickle down from downtown Denver paying $2,500 to Rhino paying $2,000 out to Sloan's Lake and then out to Edgewater. So I could very well see that 5% rent growth. I guess personally, I would have perhaps underwritten a little bit more conservatively and hope for the upside, but I could see where you're coming from that. So that makes a lot of sense.
And the one thing I would add is, because we were, closely underwriting, we went through so many versions and iterations of modeling, and I personally obviously approve this. And the last thing I want is to be viewed as having an aggressive underwriting. And so we debated this rent increase point back and forth, and I actually I was very much supportive of it for precisely that reason, that it's possible to overshoot, and it's possible to undershoot. So I thought it was a fair median. And the one thing I would add, I grew up in New York and Brooklyn, and I can tell you, I sat out a multi-decade boom because it didn't occur to me how prices could keep rising. And just when I look at Denver and the fundamentals, they're nowhere near as strong as they were in Brooklyn, like in some of these neighborhoods, Park Slope, Williamsburg, all these neighborhoods that have seen all these historic appreciation. So I see these incredible fundamentals, people moving from both coasts. Everyone wants to be there. So we're super bullish on it.
Yeah, no, that makes sense. Do you guys have kind of minimum investment levels or kind of a target investment level that you'd like your LPs to come in with?
Yeah, we have 100K minimum set.
Okay.
And, we're getting very close to, I think we're closing here in, about 10 days. So we got a couple $100,000 left, and, would prefer to, fill that out.
Okay.
Since sorry if I interject. Also, Michael informed me that the property that you have on the sales deck sold as well for $211,000 per unit, not too far away from.
Yeah. What was that? Lamar or something, or South, or whatever that.
No, this was, this one, hold on, let me pull it up. It was at the time that the deck was drafted, it was on the market, and then it sold close to the asking price.
So that's a good news, but that property does have a lot bigger unit sizes. How do you see that play role in how we how the property perform moving forward.
Yeah, so let me field that one because
Okay.
I looked at it when we spoke about it.
Mhm.
So the advantage this property has is we've allocated a very healthy renovation budget for, so essentially brand new interiors and sort of top shelf amenities that are very much in demand. I think the property you're talking about is the Lime Apartments, was very nicely done. But their location wasn't as great, and they were also next to the highway. And so, look, I don't think there's right. It's a trade-off of square footage versus location and sort of perceived amenity class. So I think it balances out. That's kind of our view.